And so we've got our forecast, we're moderately bullish. We've got our the magnitude that we're expecting for the increase in the stock, in this case 10%, and our timing, we're looking for 30 days. When we look at our options chain with all of that criteria in our head, we decide to buy the at-the-money $100 strike call for $5 to offset our risk a little bit, to lessen the money coming out of our pocket. We're going to go ahead and sell the 110 strike. That is going to give us a $1 credit from the sale of an option. We put the two of them together, $4 debit or $400 per option is what's going to come out of our pocket. So by selling that option, we just reduced our risk from $500 to $400, right? So we reduced our risk by 20%. We reduced our cash outlay by 20%. The trade-off is that we also are reducing our potential reward. So our maximum gain with this is going to be the difference between those strikes, the 110 and $100 strike calls. The difference between that is $10. We're paying $4 for this spread. So our maximum reward, our maximum potential is going to be $600. Our maximum gain is going to be that which we put into it, again, $400. And then our break-even point is going to be 104. That is our low strike call plus the premium that we pay. So our low strike call is 100. The premium that we pay is 104. That's where we begin to make money. Without that call option, our break-even would be 105. So not only did we reduce our cash outlay and our risk, but we also reduced the point at which we begin to make money, which increases the probability of success for the trade as well. For those of you that are graphically inclined, let's go ahead and see what all of this looks like and what might happen at expiration. So here is our profit and loss point. We've got our short $110 call, that's at the top. Our long $100 option, that's at the bottom. You can see our break-even point of 104. Now at expiration, if shares finish above that 110 strike, that's what we want. The reason is both options are now in the money. Our long $100 call would be exercised. We'd buy stock at 100. Our short 110 call, we would expect to be assigned. We're selling those shares at 110. And we realize our maximum profit of $6 or $600. $10 profit on the stock minus the $4 premium that we paid. Now, if shares finish below 100, both options finish out of the money, and we're going to lose the entire premium that we paid, so that $400. And remember, this brings back the earlier point that your forecast is really the most important thing when it comes to a successful trade. If you think the market's going to go up and it goes down, it's going to be hard to make money. If you think the market is going to go down and it goes up, again, it's going to be hard to make money. So our forecast is going to be paramount.